Hi folks, David Waring here again with InformedTrades.com and a special video series on the fall of Bear Stearns. Now that we have an understanding of the basics of the subprime crisis as well as some of the different components involved, we have a great foundation which we can now leverage to gain a better understanding of what happened to Bear Stearns. So with this in mind, we're going to look at, in this video series, exactly how Bear got to the place where they are today, the role that the Fed has played in the great debate surrounding that role, the deal that they've struck with JP Morgan and the great debate surrounding this, as well as some things to watch out for going forward. As most of you probably know by now, Bear Stearns, pending shareholder approval, has been sold to JP Morgan for the price of $2 per share. This is a stunning fall from grace for the country's fifth largest investment bank, which values them at $236 million, or about a quarter of the value of their Manhattan office building. While a terribly sad event for the company's employees, many of whom will probably lose their job as a result of this, and many of whom were shareholders in the company and had large amounts of their wealth tied up in the company, this is also an event of historic proportions for the financial markets with many lessons to be learned. So with this in mind, the first thing that it's important to understand when trying to get a grasp of what happened to Bear Stearns is the basic background of the subprime financial crisis. So if you haven't done so already, I encourage you to go through our 3-lesson mini-series on the basics of the subprime financial crisis, which you can find in our Subprime Crisis Learning Center at InformedTrades.com. In those lessons, we learned that these pools of mortgages or mortgage-backed securities and collateralized debt obligations, as they're called, are at the center of the problem that the financial markets are experiencing right now, and the reason why a lot of these banks are taking these big write-downs. Okay, so the first thing that's important to understand here is that Bear Stearns was a major player in the mortgage-backed securities markets, with not only in securitizing that debt or repackaging those mortgages up and selling them off to the market, as we learned about in our first series, but also an active participant in actually holding a lot of these pools of debt on their books. Okay, so while many of the other banks who participated in the mortgage-backed securities markets, also held some of these on their books and also lost money as a result, as we're seeing now with all these write-downs. The difference with Bear Stearns is they were not anywhere near as diversified as these other banks, and this was a very concentrated part of their business. As we also learned about in our first series on the subprime financial crisis, the way that these banks were trying to make money is by leveraging their credibility or the credibility of their balance sheet and their creditworthiness to borrow money at very low short-term interest rates from other financial institutions, and then take that money and buy this longer-term debt, which paid a relatively higher amount of interest, and then they would earn the difference between the two interest rates. Because they were borrowing this money on the short term, however, they had to periodically roll over, it's called, or renew those loans so they could continue to meet their longer-term obligations on this longer-term debt. So the problem that arises is when one of these banks or one of these financial institutions has a deterioration, it's called, of their balance sheet, or they lose money somewhere, so they're not as creditworthy, just like an individual wouldn't be if they lost money, then they put themselves in a situation where they may not be able to borrow this short-term money at low interest rates anymore. And so essentially, you can think of this sort of like a run on the bank like we used to have in the early part of the 20th century here, but just the main difference here being is that instead of it being individuals rushing to the bank to pull their money out, because this is an investment bank, it was institutions rushing to the bank to pull their money out, and also pulling their loans and not being willing to loan Bear Stearns money anymore so they could meet their obligations, and forcing them into bankruptcy. Okay, so that's a little bit of a basic overview of what happened. We're going to go into a lot more detail in the videos to come here, but now I wanted to set us up so we could discuss in our next lesson exactly why the Fed felt like they had to step into the situation and sort of bail Bear Stearns out, and the large debate there is surrounding whether or not they should have done that, so we can grasp an understanding of both sides of that debate. So that's going to be the topic of our next lesson. For more great information on the subprime financial crisis, please visit our Subprime Learning Center at informtrades.com, and have a great day.